Hi guys, welcome back to my channel. Kelvin here. So I've been investing for almost 5 years now and I'm still not a millionaire yet, unlike some lucky guy. Naturally, I was a noob at the start and right now I'm slightly lesser noob, I hope. I've made a lot of investing mistakes over the years and each of the mistakes caused me to lose some money. Imagine I'm in the Street Fighter game and each mistake is like punch and my money health bar keep dropping. Luckily I haven't kena KO yet. So in this video, I will share 6 investing mistakes that I made so that you don't make them. Sounds good? Let's start right now. First, staying in Singapore market. I first started investing in Singapore stocks, but what I didn't realize at that time was Singapore stocks move super duper slow. How I know? Check this out. In Singapore, there's something called Straits Times Index, or STI for short. It tracks the performance of the top 30 companies on the Singapore Exchange. Companies like DBS, OCBC, Singtel, CapitaLand, and so on. Then in US, there's something called S&P 500. It tracks the performance of the top 500 companies in the US. Companies like the fruit company Apple, Microsoft, Amazon, Google, and so on. So let's compare the performance between STI and S&P 500. Since 1993, or for the last 18 years, the S&P 500 gave almost 900% return, while the STI gave only 186% return. This shows that the companies in the Singapore market grows very slowly. The main reason is that the companies in Singapore have a very limited market, like our DBS, only has business in Singapore, Indonesia, India, China, Hong Kong, and Taiwan, while companies like Google and Apple operate in almost every country in the entire world. Yes, they even have Google in Wakanda. So that means if you want a higher return in the stock market, you need to get out of Singapore and start investing in the US market. Sure, US stocks are much more volatile than Singapore stocks, but as long as you are holding good stocks and not some meme stocks like AMC, you will most likely do well over the long term. Second, and this is a very classic strategy that many investors like to use, trying to time the market. They think that they can buy the stock at the very bottom, then sell at the very top, then they will quite big. Can, you think so easy? Then you go try lor. In the past, I used to wait for stocks to drop, and I wait long. Meanwhile, the stocks be like, I go up higher and higher. In the end, I miss out on the entire run-up. That's when I realized I'm both a noob at timing the market and timing the stance in LOL. There's a lot of data which shows that trying to time the market is always a bad idea. For example, JP Morgan found that if you just hold your stocks and do nothing from 1999 to 2018, you will get the highest return. If you try to time the market but miss the 10 best days, then your return drops by more than half. Remember, you just missed the 10 best days over 20 years. Then you GG liao. And if you miss 20 best days over 20 years, then you will have a negative return and will be considered a noob instead. What makes it even harder is that 6 of the 10 best days usually happen within 2 weeks of the 10 worst days. Like in March 2020, when the market was dropping like grapes.
It drop like grapes, no? Can drop.
Hitting circuit breaker after circuit breaker after circuit breaker. Most investors would panic sell, then plan to wait for a few months for the market to drop further. But no. Turns out right after that, the 8 best days of 2020 occurred immediately during and after the crash. So if you want to avoid missing out, stop trying to time the market because you are not fucker. Only fucker can time the market. Instead, you just consistently dollar cost average into the stock market. Market goes up, you buy. Market goes down, you cry a bit, then you buy more. Third, investing in commodity companies. When I was still investing in Singapore, I invested in 2 commodity companies. The first one was Golden Agri, which is a palm oil company. Right after I bought in, it started dropping. That's when he knew he fucked up. The second company was CNMC Gold Mine Holdings. Basically, they mine gold. Same thing, after I bought in, the stock be like, he bought in, let's crash ah! Here's the thing about commodity companies. There's 2 moving parts, the company and the commodity price. If the company doesn't do well, they have a lot of debt and they couldn't sell the products, you GG lor. Or maybe the company does well, they got a lot of harvest, but if the commodity price drops, then you GG also lor. The company can't really control the price of the commodity, so the most they can do is warming tea and pray that the commodity price will go up to even have a chance to profit. So avoid commodity companies. Instead, look for companies that can generate its own recurring revenues by relying on its customers. For example, Adobe, the customers have to subscribe to use their products. Or maybe Amazon. Companies rely on Amazon to host their servers and customers rely on Amazon for delivery. Next, not researching into companies. When I first started investing, I didn't research into the companies that I'm buying. Every day, I was looking at the top gainers of the day and be like, if the stock today can go up 20%, then the stock tomorrow can also go up lor. So simple. What I didn't realize at that time was that I was investing like an ape. Because of that, I lost a ton of money. Here's the thing, if you don't research into the company that you are buying into, there's zero difference between investing and gambling. And no, by researching I don't mean going to Wall Street bets and see those to the moon kind of research. By research, I mean you need to know how is the company making money, what's their future plans, are the management good, who are their competitors, does the company has a strong moat, stuff like that. There are lots of places where you can research about the company. I usually research about the company by watching YouTube videos and reading articles from blogs like Seedly. But just be careful, there are lots of channels that only talk about the good side of the stock. The term for that is echo chamber. They only tell you what you want to hear. You don't want to only hear about the good stuff, you also need to know about the bad side of the stock. Let me give you an example. For Tesla, there's a channel called Solving the Money Problem. Steven will tell you everything you need to know about Tesla. Why is it so good? Why it will go to the moon? Then some channels like Investing with Bros or even Andre Jake will give you a more balanced view. They will tell you that even though Tesla is a good company, it is super overpriced right now. So try to look for videos or articles that say why they don't like the stock. That way, you will have views from both sides. And also, don't just blindly trust what you read. You still need to use your head to think. Don't be like, if you like the stock, then I like the stock. Make your own conclusion because in the end, you are investing your own money. Next, fear of missing out or FOMO. What do you feel when you see this chart? When you see it, then you will say, wow, it's going to the moon. I want to buy also because apes together strong. Let me show you usually what will happen. The stock will go down and right, of course. It's super predictable. Stock that has run up too fast has only one way to go, and that is down. Here's why. In the short run, the market is a voting machine. It's the traders and the apes that control the stock price. They will buy into the stock just because it is going up. And because they bought in, the stock price goes up. You should attract more people to buy into the stock. You should cause the stock price to go up even higher until it reaches the point when the guy says, "Aiyo, so expensive, time to sell and run." Then the stock price drops a little, then the next guy will be like, "Wow, dropping now, zao ah." In the end, the stock will crash super fast. In the long run, the market is a weighing machine. Despite what many people tell you, fundamentals are still important. It's like in Looney Tunes, the characters can walk over the cliff and not fall down, but eventually, they will still fall. Same thing for stocks, especially in 2020 and 2021. They were churning so much that it's like FOMO everywhere. Tesla goes up 800% in a year. You FOMO in? It come back down. AMC up 2000% in 6 months. You bought in? It come back down also. ARK ETFs, best performing ETF of the year. You bought in? They all come back down also. So don't FOMO, take it easy because chances are stock that has gone up a lot will come back down. If the stock went up, find out why. There's usually two reasons. First, Wall Street bets is pumping the stock to punish hedge funds, or the company is really good. For me, if it is a stock that I like, even if it went up, I would still buy, but I would buy a bit instead. For example, when Tesla went up to $800, $900, I bought in at a much lesser amount. Then, when it came back down to $600 range, I started buying more again. Next, on the other side of FOMO is selling away winners. Let's say you bought a stock and the stock goes up 20%. What do you normally do? Some people will be like, wow, went up liao, time to sell. Tonight got money eat chili crab. And right after they sell, the stock goes up and up and up. Meanwhile, you're holding the cash and be like, now what? In investing, the lesser things you do, the lesser mistake that you will make. And no, it's not like that smart guy meme. If you never sell, you never lose money. I'm being serious. Let's say a stock went up. You will now have 3 options. Option A, you sell and wait for the stock to come back down. Sell high and buy low ma. Everyone knows that. But if the stock never comes back down, then you will miss out on a lot of gains and will look like a noob. Option B, you sell and find another stock to buy. If you bought the right stocks, good for you. But if you bought the wrong stocks, you suddenly lose all the money that you have earned and you will look like a noob also. Option C, you don't sell, just let the stock go up or go down. It doesn't matter because over the long term, good stocks usually go up. Personally, I will choose option C. I don't sell. I just diamond hand and hold the stock. You guys will then ask me, when will you sell the stock? There's two scenarios I will ever sell the stock. First, I will only sell the stock if the fundamentals change. For example, Nokia, it was doing well until Apple came along. Then it started losing business. In that case, I would sell. Or second scenario, I will only sell if I ever need the money. Maybe I found a better investment, or maybe I need money to buy Chai Fan. So if you ever bought a stock that went up, congrats. If that's a good stock, just keep holding because chances are it will continue to go up more. So those were the 6 investment mistakes that I made. Hopefully, you will be able to avoid all this so that you can whack big. What are the investment mistakes that you know of? Let me know down below. And that's all for today. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.